Hi everybody, so I thought I'd put a video together regarding this issue that I raised yesterday in the group about annual tax on envelope dwellings within a limited company. The idea being that if you are holding your property portfolio now under a limited company wrapping, there is this annual tax on envelope dwelling that is now being triggered. Apparently it has always been around, but the threshold for it to kick in has now been lowered. So in effect, if you, like myself and everybody else who migrated our legacy portfolio but also have been buying under a limited company kind of company wrap, this tax now applies to you and I for any property that we have and hold in that limited company that the market value of that house is 500,000 or more. And if you look at my post, you will see the table that I've posted there. But in effect, any house or property, I should say, that's worth £500,000 up to £1 million, the tax is an annual tax on that property, and that costs an extra £3,700 in terms of taxation. So that's the first bit to know. So if you have your properties but they are below £500,000 in value, there is no annual tax to be paid, thankfully. The average house in the UK right now is around £250,000 to £300,000, depending on which source you work at. But I think it's really £250,000 is what I'm using at the moment. If that's the the average price of a property in the UK, that takes out a lot of the burden for landlords. So most properties we hold will be below the £500,000 threshold. Having said that, if you are within the southeast of England, certainly in London, and you've got 2 3-bed houses as your stock, you might find, if not now already, but in time, some of these will tick up in terms of valuation up to the 500,000 and more. So the minute they go over 500,000, that £3,700 as of today will become payable, and that's on each property annually. I mean, that's crazy in terms of the amount of tax that we'll end up having to pay now. So that's the first thing. So have a look, speak to your accountant, have a look itself at your own. I've posted the link also in this post. Have a read around on the HMRC website. I'm told by my accountant that you can either use the accountant themselves to submit it for you, or you can go online and on the HMRC website and file a submission yourself. So annual tax envelope dwelling, so ATED is the abbreviation if you want to Google it. So that's the first thing to say about the tax. It's another tax, another self-tax now, based on landlords. Where does it not apply? If you're a landlord but you are renting social housing, that tax doesn't apply. If you're a developer and you're buying, doing up and selling, that tax doesn't apply. And also if you are a property trader, that also doesn't apply, because you're literally going to be buying it and trading it on. So these are really mainly for people like myself who buy and hold and then generate a rental income. So that's not great news, and I'm sorry to be the bearer of bad news, but you'd rather be informed than not. The other thing I wanted to kind of mention is there's going to be unintended consequences of this policy now, because you have traditionally not have had buy-to-let investors compete with homeowners and first-time buyers. But right now with this policy, what will happen is a lot of investors will start thinking about this annual tax on envelope dwelling and will really be put off buying anything above or even around the £500,000 threshold. And that means that they will drop their threshold down and start competing at the cheaper end of the market. There's already a boom in the market at the moment. This will only but compound the effect. So I think there will be some unintended consequences of this policy around the taxation. So I'll leave it there. If there's anything else that comes up, I will post a bit more, but just to recap, annual tax if your properties are worth individually, and this would have been valued in 2017, so the valuation that was carried out at that time would determine the value of each property that is on the review. If they were valued at £500,000 or more at that time, they then will be liable for this tax. There is a new valuation being carried out in April 2022, so also be aware that you might have escaped in 2017, but with the boom in property prices recently, come next year, April, literally a year from now, you might not be that lucky where these properties would have ticked up to over 500,000, and where the £3,700 of extra tax per year will become due. So take a look at that. If it's above £1 million, then it goes up significantly. We're talking above, between I think 1 million to 2 million. We're looking at almost £25,000 worth of annual tax that you'll have to pay. So take a look at the table and the link below as well to get the exact figures.